Many successful commercial real estate investors will tell you that their best deals were bought out of state. Big dollars made, big profits. And an equal amount will say also that their worst deals were bought out of state. Big headaches and big losses. So what's the difference? How do you get and stay on the successful side of making big dollars when investing out of state? That's what today's video is on. 7 tips when buying commercial real estate from long distance. Hi, I'm Peter Harris with Commercial Property Advisors. I am author of this book, Commercial Real Estate Investing for Dummies. Co-author of a new best-selling book, Commercial Real Estate for Beginners. I'm also a coach and mentor to many commercial real estate investors all across America. In today's video, you're going to learn what's the attraction of buying property from long distance, out of state. Also, what are the challenges? There are challenges and they are great, and there are many when buying properties from afar. Number 3, can I buy commercial real estate without seeing the property? I have a very strong opinion about that. And number 4, I'm going to give you 2 alternatives to buying commercial real estate out of state. And number 5, last but not least, I'm going to share with you in great detail how to successfully buy commercial real estate from long distance. Let's get started. Tip number 1. Tip number 1 is you should know what the attractiveness is in going out of state to buy commercial real estate. That's tip number 1. There are 3 reasons why. Number 1 is affordability, right? It is perceived that if you were to go out of state, that you can achieve higher rate of return, higher cash flow, and faster portfolio growth. That can be true. Now, if you look at the 2 different cities, 2 great cities, San Francisco, California, and Dallas, Texas, 2 great prosperous cities, right? A 12-unit apartment building in San Francisco will probably cost you about $7.5 million. That same building, 12-unit in Dallas, Texas, will cost you about $1 million. So you can see the affordability there, right? You can literally take your $7.5 million from California, go into Texas, and buy an 80 to 150 unit apartment building. So you can see the differences there, right? In fact, some of our students have set a 5-year goal of acquiring through syndication 1,000 apartment units. That will probably take place not in San Francisco, but in more affordable areas like Texas and other states. Got it? Okay. Reason number 2 is diversification. Now, those that are compiling their real estate portfolio may not want to have it in one area. They may want to spread out into other great areas. That's completely fine, right? So, but one thing I'm going to share with you is as you do your research on that, you have to know, and sorry to burst the bubble, that there is no such thing as a national real estate market, okay? It does not exist. What exists are submarkets. Let me give you an example. In Portland, Oregon over here, that real estate market, right, is probably at the peak compared to Portland, Maine, okay, which is on the East Coast, okay, which is not at its peak right now. So same country, 2 different markets. So the market in Portland is completely different, and Portland, Oregon, completely different than Portland, Maine, right? So you have to understand that, but diversification is a smart thing to do. You just got to do it smartly. All right. The 3rd reason why buying out of state is so attractive is to increase deal flow. If you live in a high-price area or states like California, New York, you may want to think about going to the lower-price states such as Tennessee, Texas, Florida, South Carolina, where there are more deals, all because you expanded your search. Okay, got it? Okay, so these are the 3 main attractions: affordability, diversification, and increased deal flow. All right, so the next tip I want to go over with you is to answer the question, is it a good thing for you to buy a commercial real estate property without seeing it? Let's go there next. Tip number 2, should you buy a commercial property without seeing it first? Here's my short answer. No. Here's my long answer. Heck no, don't do it. Let me share with you why. Number one is, when you're considering buying a commercial property, it's probably the biggest investment in your life thus far. Why wouldn't you want to see it? In my opinion, it's irresponsible. You're a poor steward, and you're just asking for trouble. Okay? Number two, no matter what ROI is promised to you, don't do it. Sometimes you'll be presented a deal where the cash and cash is great. It's 20% ROI, 100% ROI, just too good to be true, right? Don't do it. It's irresponsible, and it's not a very smart thing to do. So no matter what ROI is promised, don't buy it without seeing it first. Go see it, all right? Number three, let's talk about consumer protection laws. When you buy a property that's out of state and sight unseen, let's say that it's a residential property, like a single family home up to a fourplex. That's considered residential. In nearly all states, the seller, the owner of the property, has to provide you disclosures, property disclosures, telling you what's wrong with the property. And if you close and buy it and they lie to you, there's recourse. You can sue. In commercial, no such thing. It's buyer beware. The seller can lie through his teeth, and you can buy the property and fail, and you can do nothing about it. All right? So that's why you cannot buy a property, a commercial property, without seeing it. Don't recommend it. All right? People will say, but Peter, I'll just hire a property inspector to inspect it for me. That's great, and you should do that regardless. Okay? You should always do that. Have a professional property inspection done to all of your properties before you're buying it. But to not go see it is pure laziness. Got it? Okay. I think I shared my opinion on that topic. I think you understand where I sit on that. All right, so the next step I want to share with you is I want to give you two alternatives to buying commercial property from long distance, for example, out of state. Okay, let's go there next. Tip number three is two alternatives to buying commercial property from long distance where you don't want to be involved. Okay, so alternative number one is through a real estate syndication. So in this case, in syndication, you have to find someone with a great track record of investing in real estate, very well experienced, that's honest and you trust. And what they will do is they will put together a syndication, which is a pool of other people's monies, including yours, and going out and buying a large commercial property, an office building, apartment building, a self-storage, retail center. Okay, a large property, pulling everybody's money together, so buying a property larger than you can afford individually. That's what it is, okay? Syndication. And so basically in syndication, you let someone else do the investing for you. It is a passive investment. So you're not active investment. You're an investor just receiving a return on investment. And I have a video on real estate syndication, and it's called The Basics of Real Estate Syndication. It will appear on the screen, so go ahead and watch it, and just to get introduced to the concept. The second alternative is REITs, also known as Real Estate Investment Trusts, right? And what that is basically is a company will go out and acquire a portfolio of large commercial properties, for example, 10 office buildings in a certain area, and they will form a company and they will sell to you shares in a company. So, right, so you will be a stockholder, right, of that company, an investor, again, a passive investor. So this is a large company selling shares of stock to you. That's called a REIT. It is also passive. So a REIT allows you, let's say you're in Hong Kong, it allows you to participate in the operations and the cash flow generated of a portfolio of 10 office buildings in Phoenix, for example. So with the REIT and with syndication, you can participate in commercial real estate investing around the world, basically. All right. I also have a video called The Basics of REITs, and that link will appear on the screen as well. So go ahead and watch that to get introduced to that principle as well. All right. So on tip number 4, what I want to discuss next is I want to give you some guiding principles on how to go out there and set yourself up for success when buying properties out of state. Let's go there next. Tip number 4, guiding principles. When you bought your house, you had guiding principles. You knew where you wanted to live. You knew how many bedrooms you needed. You knew it needed this, it needed this, it needed that in order for you to be successful there, right? Now, there's no difference when you're buying commercial property. You need guiding principles, and it's really even more important when you're buying property that's out of state or long distance away. Now, here are the guiding principles if you're deciding to buy a property that's out of state or from afar. Number 1, all of these are important, but this one is so important, okay? You need at least a 10% cash on cash return. Some people say it doesn't exist. I say don't buy the property then, okay? It's that simple. You need at least a 10% cash on cash minimum, because if you have some vacancies, if you have some repairs, or a combination of the two, and you're far away, it is really tough dealing with that from far away. You're going to get to break-even point or maybe even negative cash flow. It's far away, it's tougher to keep an eye on it. That's why having a minimum 10% cash on cash return gives you enough room to weather the storm for vacancies and repairs. Got it? Okay, really important. Now, these guiding principles also apply to a property that's, in your city. But it's really important, these 4 are really important if you are doing it from long distance. Number 2 is to hire a property management company that's well vetted, with a track record, has a host of happy clients, and willing to be held accountable with timely reports and occasional phone calls and visits. If they fight you on that, that is not your company, period. Period. They are trying to hide something. The fact of the matter is that 9 out of 10 property management companies will not work for you. They're not good. They're actually ruining your property. That's a pretty harsh statistic that I didn't make up. That's just a fact out there. So this is really important to allow you to, what I do, it allows me to sleep at night if I know I have a good property management company and the property is not where I am. Number 3 is population. You need the population to be growing. Really important, right? A growing population equals a healthy pool of tenants. Tenants pay rent. The rent is your income. You are in the income business. Do not invest someplace where there's a lack of sources for income. Simple, right? Okay? Now, small towns are okay. Okay? They're okay if their radial population is healthy, right? So if you have a small town with small population, but surrounding it are larger cities feeding into it, that's fine. In other words, do not invest in rural areas, right, where there's no big cities supporting it and feeding into it. Got it? Okay. Number 4, the 4th guiding principle is to invest in cities that are landlord or investor friendly, right? You don't want to invest someplace where evictions are difficult, where they're timely, where they're costly. Believe me, from afar, it is a hassle. It's not conducive to successful investing long term, in my opinion. Okay, so these are the 4 guiding principles. Question here, when you look at your deal that's out of state, are any of these missing? Right? If one of these are missing, simply don't do the deal. That simple. If one of these are missing, don't do it. Got it? Okay, 4 guiding principles that you can't leave home without. All right, let's go to the 5th tip. And the 5th tip is to buy a property, a commercial property that's big enough. Let's talk about that next. Tip number 5 is to buy a commercial property that's big enough. Right? That's tip number 5. But the question is, big enough for what? Well, big enough for you to afford to place professional property management on the property. If you are on the East Coast or left coast and your property is a small property about 1,000 miles away, so you can't get to it easily, and it's a small property, let's say it's it's a 5-unit, right, and you are 1,000 miles away, most likely you cannot afford to pay the 8 to 10 to 12% property management fee. It'll eat up all your cash flow, right? So when you're investing out of state or far away, buy a commercial property that's large enough with enough income to afford professional property management. Got it? Okay. Now, well, some people will say, Peter, I'll buy the 5-unit and then I'll manage it myself, right? If you're a beginner, I'm against that, because don't self-manage if you are a beginner, a commercial property. Here's why. You need to have a skill set, right? This skill set took me years to develop. And let me ask you this, all right? Do you have the skill set to manage money from 3,000 miles away? Do you have the skill set to manage an entire maintenance program? Do you have the skill set to manage and design a marketing system for your property? Do you have the skill set to manage a small staff? If you don't, you're asking for trouble if you think that you're going to save money by self-managing the property, especially if you're a beginner. You don't have the skill set, buy a property that's big enough to afford professional property management. All right, lastly, this is a fact. Our students, all right, our commercial students' best deals are from owners that self-manage from far away, right? And the reason why they're the best deals, right, with the highest cash flow, highest profit potential, is because the owners that self-manage don't have the skill set to manage cash flow, to manage marketing, to manage maintenance, to manage the staff. So the property is not operating well. It's actually operating negative, and they're motivated to get out of the property. So if you get anything from this video training, right, a sidebar is to look for properties that are out of state where the owners live out of state. So you live in this state, and there's a property here owned by an owner over here, right? He's trying to self-manage it from far away. That could be a great opportunity for you. Again, those are our students' best deals to date. All right, okay. So now you understand why you need to buy a commercial property that's big enough. All right, so let's go to tip number 6. Tip number 6 is I want to show you how to have a realistic underwriting or deal evaluation, and also to have expert due diligence when buying a property from long distance. Let's go there next. Tip number 6 is to have realistic deal underwriting, which means evaluation, and expert level due diligence. These two things are so important when investing 1,000 miles away or a different state. So important. Okay, let me share. Right, the most important number, in my opinion, in all the commercial real estate, and the reason why it's most important is because it's the most misunderstood and it's the most miscalculated number of all time. Ask any experienced commercial real estate owner who owns a bunch of property. When they first started, they missed the mark because they miscalculated or misunderstood this number, or it was misrepresented to them. Okay, you wonder what this number is? Is it rents? Is it vacancies? Is it pricing? No. Here it is. Okay, the most misunderstood and miscalculated number is operating expenses. Okay, and capital expenses. Okay, for short, we call it OPEX and CAPEX. So operating expenses are your insurance, your repairs, your taxes, your property management fee, everything that incurs on the property expense-wise in a normal operation of the property, right? Your capital expenses are the big ticket items like roof replacement, parking lot repairs, buying 25 new appliances, or some big ticket item that you don't do every month. Those are capital expenses. These two numbers are so misunderstood. The brokers don't give you bad information on purpose. They're not like that, right? The sellers just happen to leave out important numbers. So what's the solution? The solution is to have an understanding what your expenses are in your sub-market. How do you get that? Through experience. Having a property manager look at your budget for your property. Asking a coach or mentor who's been there and done that. That's the only way you're going to get realistic numbers. Don't believe a pro forma that you get from a broker, right? They're not investors. They're not operators. We are. We know what it costs to staff a 100-unit property. We know what it costs for landscaping. We know what all the employee costs are. We know all that because we do that every day. The brokers, they don't know that. So I'm not saying they're bad guys. I'm just saying that they get their information directly from the seller, and sometimes it's not right. Most times it's not right. Nearly all the time it's not right. All right? If you want to be, this word here, obsession. So if you want to be obsessed about something in commercial real estate, be obsessed, right, be obsessed with operating expenses and capital expenses if you're going to have an obsession in commercial real estate, because this is where most people miss the mark. Got it? Okay, let me move on. All right, next is, we just talked about having realistic deal underwriting where we focus on the expenses. Next is to have expert level due diligence, right? Due diligence on a commercial property is doing your homework physically, financially, and legally on the property, right? And real quick, let me share with you just 4 things about due diligence when buying a property from afar. Number 1 is you must be present. A few minutes ago I talked about I really need you to see the property before you buy it. You have to. It's irresponsible and just not smart if you don't. So you must be physically present, but also, I have this in quotations because I need you to be mentally and emotionally present as well, right? Because you can't walk down the street and go to the property if it's 1,000 miles away. When you're there with your inspector, right? When you're there with your property manager, you need to be very present because there's a whole bunch of things going on that you need to be aware of. If you miss an expensive item that's like an inspection item, it could cost you dearly. If you miss something on the financials that were discussed and you forgot, it could cost you dearly. The same thing with the legal side, okay? So being present with your inspector, with your property manager. And then lastly, most important, you need someone smarter than you, with more experience than you, helping you with your due diligence. You can't do it yourself because you're a beginner. I can give you checklists, but you need to decipher what the results are in each of the items in a checklist, all right? That takes experience. So get a coach, get an advisor, get someone who's smarter than you to help you with due diligence, or you can be in big trouble if you buy a property from afar and you don't have this expert level due diligence. All right? Okay. All right, so let's move on to tip number 7. I'll see you there. Here we are, tip number 7. Before I begin, I just want to say thanks for hanging out with me today. I have purchased property remotely for almost 20 years now, tens of millions of dollars in properties from afar. And I can attest to all of these benefits, right? So if you adhere to and listen to and take advice from what we have to say here, you too can share in properties from afar with greater cash flow, big profits, more deals, that's for sure, faster growth. Portfolio growth is faster when you can go out of state, and having valuable relationships. I cannot talk about this more. As you guys know in my videos, I always reference how commercial real estate is a relationship-based businesses. Deals are found, capital is raised, problems solved. Things happen because of the relationships that you create in this business, okay? Whether you hear or you do it from afar. So it's really important, right? So tip number 7 is don't invest beyond your knowledge, right? So you have to get knowledge. Where does the knowledge begin? Well, it begins by me summarizing what we just talked about. Your knowledge begins here. It begins right here. First of all, you have to visit the property. You do. You heard my opinion on this. You have to have guiding principles that I gave you. You have to buy a property big enough that you can afford professional property management. And number 4, I want you to lead your search with a property management company. You need that company, that person with the boots on the ground that can see and check everything out for you, including having the market knowledge so that you can make the best decisions moving forward. Next is you really need to know your numbers, okay? few minutes ago I talked about what the most miscalculated, misunderstood number is, and then you really have to know your numbers as well as the market. You really have to know, right, what type of market it is, and if it's growing, is it shrinking. You really have to know all that. Okay, this is where your knowledge starts. And lastly, know that it's a team sport. Okay, it goes back to creating relationships, building your team up with the right people in order to be successful buying commercial real estate from long distance. All right, okay, hope you enjoyed the video. If you want more videos like this, feel free to subscribe to this YouTube channel. Thank you so much for watching 7 tips when buying commercial real estate from long distance. Goodbye everyone. Thank you very much.